Okay, this video is on accounting for business combinations. The one thing you don't want to get this confused with is accounting for business consolidations. They're two separate practices. So this one is accounting for business combinations. And a business combination is a transaction or some other event in which an acquiring company obtains control over one or more other entities. Now, if we define control is defined as a controlling financial interest. It's a direct or what we call indirect ability to, in effect, determine the direction of management, and the policies that of the company acquired. Now, this usually means uh, basically the entity's direct or indirect ownership is more than 50% of the outstanding voting interest of the acquired entity. Now, let's go ahead and take a look at the rules that under generally accepted accounting principles that have been set out for how we go about accounting for acquisitions. And the first thing is we consider the percentage of ownership of the voting stock. Based upon that, then we derive what we call a presumed influence, and then based upon that, then we consider the appropriate accounting method. Now, if you take a look here, the percentage of ownership of voting stock, if it's between 0 and 20%, would mean our presumed influence is, as an acquiring company, is little or none. Therefore, the accounting method that should be used for that acquisition should be typically at fair value, classified as available for sale. Now, if we go between 20% and 50%, the presumed influence is that the company has significant influence. And in this case, we would use either the equity method or the fair value option we just talked about. When the ownership of voting stock exceeds 50%, our presumed interest now is called controlling, and the accounting method used in this case would be the consolidation method. Now, we have to remember here we're using the word presumed influence, and let's take a look at this big bubble, this bubble explanation at the top. I say, okay, with presumed influence, however, percentage of ownership only reflects presumed influence, not necessarily the actual reality of influence. For example, a company with a 50% plus voting interest in another company still may not have a controlling interest, since the acquired company may actually be under the control of a bankruptcy trustee. So the other company still legally has to work within the control of that bankruptcy trustee. Or another example is the acquisition is considered really a temporary investment by the acquiring organization, or the acquiring organization executed a standstill agreement with the acquired company, meaning that they, as part of the process of the acquisition, they agreed that certain things wouldn't change, and it could be that they agreed that they wouldn't change the board of directors for at least a certain period of time. Now, it goes the other way too. Even if the acquiring company owns less than 50% of the voting stock, it still may have a controlling influence or interest in the company if the acquiring company controls the acquisitions, the company they've acquired, the acquisitions board of directors. So we have, even though we have these numbers as guidelines, we still have to consider it's the actual influence that counts. One other thing we need to insert in this percentage of interest table, that if our percentage of interest, ownership interest of voting stock exceeds 50%, but the parent does not have a controlling influence on the sub, the parent must use the equity method of accounting. Now remember that when one entity controls another entity, consolidated financial statements of those two entities must be presented. And again, when we say control, control means to determine the direction of management and policies of the investees. Now, consolidated reporting represents a parent and the sub as if the entities are a single financial unit. And if we look again at the percentage of voting stock owned, we presume that at the 50% level, we automatically control the subsidiary company. Now, we can do that through what we call a direct method or an indirect method in terms of ownership. Notice here under the direct method, our parent basically owns 75% of sub A, which means the parent controls sub A. Sub A controls 60% of sub C. Therefore, we exert control across the board through 75% of sub A, and then A having 60% of sub C. So that would be a situation where we would normally consider a consolidation. Now, there can also be indirect type of interest. And this is where, here's an example where the parent controls 75% of sub A, and sub A controls 30% of sub C. Now, sub C, that's not enough to hit the 50% mark, but in this case, we also know that the parent owns a portion of sub C. In this case, it owns 35% of sub C. So in effect, if we look at the total controlling interest, it's the 30% from sub A plus the 35% from the parent company. Therefore, the total controlling interest over sub C would be 65%. And in this case, we would consolidate the parent sub A and also sub B. And again, this last box is a reminder regarding effective control. Even if we don't have 50% of a acquisition, there may be many times where we'll actually consider the fact that we have the control over the entity. And examples again is if we control, or the parent company controls the board of directors, or if there's a contract between the sub company and the parent company that effectively manages the sub company. And there's many different examples like that. Okay, now we're going to talk about the when we make an acquisition, the recognition of the transaction. Okay, now for the acquisition, the acquirer must recognize the identifiable assets that are being acquired, the liabilities that are being assumed in the by the company being the company that's acquired, and any non-controlling interest in the acquiree. Now, the assets and liabilities that we're recognizing must be recognized basically as part of the consideration transferred basically for the acquiree. Also, the acquirer must identify any amounts that are not part of the exchange and then account for them according to their nature and the relevant generally accepted accounting principles. Now again, as I said before, what we do when we recognize this transaction, this acquisition, we're going to recognize again all identifiable assets acquired, liabilities assumed, and non-controlling interest basically in the inquiry or the acquiree. Okay, acquisition costs such as commissions, consulting, legal, and accounting fees are typically expensed as they're incurred. Direct cost of equity associated with the acquisition, such as if we issue some new stock to pay for a portion or all of the acquisition, the cost associated with issuing that equity should be a reduction in the paid-in capital and shouldn't be included as an expense or part of the cost of the acquisition. Also, costs associated with the issuance of debt should be amortized over the life of the bond if we're going to be issuing debt within the transaction. Now, there can also be, the one thing I didn't mention here, there can also be a situation where a form of a pre-combination transaction before both entities are combined, in effect, and that transaction primarily benefits the acquirer. That's typically accounted for separately from the entire exchange. An example of that would be where an acquiree, in other words, the organization being acquired, decides to make severance payments or agreement to make severance payments to certain executives when this expected combination is completed. Then, in this case, its main purpose, in theory, is to benefit the acquiring company. People go, well, wait a minute, it's the acquiree who's making the deal for the acquiree's executives. Well, this is also to make sure that the executives remain there, which is again for the benefit of the acquirer. So the payments are not part of the exchange. If the main purpose is to benefit the acquiree or its former owners, the payments are normally then included in accounting for the combination. Okay, let's take a look at number 1. At the end of July, Cowsill Company exchanged 100,000 shares of its $40 par value common stock for all of the net assets of Bleecker Street Enterprises. The fair value of Cowsill's stock was $72 on the date of the transaction. Cowsill paid a $320,000 commission to the investment banker. Direct cost of registering and issuing the new equity amounted to $160,000. So the question is, at what amount should Cowsill record the acquisition of Bleecker's net assets? So you have 4 choices. Go ahead and do your computations. Don't forget to stop your video, and then when you have your answer, your computed answer, go ahead and start the video and view the solution slide. Okay, number 1. The question was, at what amount should Cowsill record the acquisition of Bleecker's net assets? And the answer in this case is A, $7,200,000. We go back and we take apart the transaction. Consideration offered in the transaction is 100,000 shares times $72 fair market value at the date of acquisition. That means the cost was the value was $7,200,000. Now, if you remember from our previous slide, the commission associated with this is $320,000, and that would be expensed by the acquiring company. It would not be part of the value of the acquisition. Also, we issued basically this additional equity, and that cost $160,000 in stock issuance cost. And again, if we remember from our previous slide, the $160,000 stock issue cost is recorded as a reduction of equity proceeds, in effect our additional paid-in capital. So that would be the answer to number 1. Let's try number 2. A owns an 80% interest in B and a 15% interest in C. B owns a 40% interest in C. How should A account for its interest in B and C? And we're given a couple of different methods of doing it. And we also note that one is a consolidation method, or two are a consolidation method. And well, I shouldn't even say that. Basically, we have to decide what should we consolidate or what should we account for in the equity method. So again, uh, take a look at this, stop the video, stop the video, and when you're ready to make your selection or your solution, go ahead and restart the video. Okay, number 2. How should A account for its interests in B and C? And the answer is B, consolidation method for B and C. And I've reproduced the percentage of ownership and presumed influence and accounting method from one of our previous slides, so that gives you some point of reference. But here we can take a look at the consolidation process and the percentages. Here we have parent A, sub B, and sub C. We know we own 80% interest in B and a 40% interest in C. Now, that in itself would not be enough to say that we could consolidate C. As a matter of fact, what we would have to do under these conditions would, in theory, is if we follow the percentage of ownership, we would either have to account for that on the equity method or the use a fair value method. But we do have a indirect interest. We have a direct interest in C where we own 15% of C. So if we take a look at this, we control sub B through our 80% ownership. Sub B has 40% control over sub C, but then you add our direct ownership of 15% into sub C, which means there's a 55% ownership interest, which means that is above the 50% plus threshold. So we would normally use a consolidation method for both sub B and sub C. Let's go ahead and take a look at number 3. Zippo acquired Matchstick Corporation. As part of the agreement, Matchstick will make payments to key Matchstick executives, and that's totaling $5 million. Now, Matchstick already had an employment contract in place guaranteeing the president a $10 million payment in the event of a buyout. Which of these amounts may Zippo consider as part of the acquisition cost of Matchstick as opposed to expensing them? So again, go ahead and take a look at your answers. Stop the video, compute your answers, and when you're ready to when you're done and you're ready to review, go ahead and restart the video. Okay, number 3. What of these amounts may Zippo consider as part of the acquisition cost of Matchstick? And in this case, the answer is B, $5 million. The assumption of the $10 million liability to the president is not part of a separate agreement with Zippo. It existed before any acquisition arrangement had to be identified. So in effect, it was for the benefit simply of Matchstick, in other words, the acquiree. On the other hand, the $5 million to the key employees, in effect, for them to stick around after the acquisition, or at least during that part of the acquisition, was a benefit to Zippo during the acquisition transaction. So the $5 million would be part of the acquisition cost of Matchstick. Let's try, whoops, I'm sorry. And That represents the very short, or the short video on accounting for business combinations. Thank you for your time.